Good morning, everybody. I'm Nicola Barrett, Chief Corporate Learning Officer at Emory Executive Education at Goizueta Business School, and welcome to the 1st of June and our Business Over Breakfast webinar series. I'm really glad to see you all coming on board for the webinar. Over the last several decades, business models have changed substantially from traditional service and exchange models to include those with delayed profit systems. In particular, during the dot-com era and now in the social media age, it's been the norm for newer companies to raise huge amounts of capital to acquire millions of customers. And therefore, what constitutes success has shifted in the minds of many business folk to raising versus making money, at least initially. But recent turbulence in the macroeconomy has driven a renewed focus on understanding whether businesses who may not be profitable yet have a path to profitability, and if so, how long is that path going to be? Here with us today is Assistant Professor of Marketing, Dan McCarthy. He's going to share an award-winning customer value-driven framework that can help more accurately assess the underlying forward-looking profitability of a business and provide actionable drivers to leverage to accelerate that profitability. He's an expert in customer lifetime value, and Dan has explored many facets you may have seen in the news on CNN and leading journals for his research on Blue Apron. So he's very knowledgeable on the food delivery service in particular. Currently, his research applies state-of-the-art deep learning methods to predict what customers will spend, and therefore, in turn, what the revenue expectations of companies as a whole will be, a project which he is very excited about. Before I hand over to Dan, I'd like to share a few program offerings, one of which is Dan's Customer Lifetime Value MBA level course. Registration is open for seats in these selected executive and evening MBA electives, including Dan's. And so if you or someone on your team is interested in building your knowledge and competence in leveraging customer lifetime value approaches, or taking a deeper dive into other critical marketing or finance topics, and in the process earn Emory University degree credits, please reach out. The classes start at the end of August, but seats are limited. Also, we're taking applications for our Executive Women's Leadership Program. That is a 6-week experiential hybrid learning journey, starts in mid-August, and we're very excited to be able to open that up again. We're going to put the links in the chat here. Back to today's session, Dan's going to spend the first part of the webinar sharing his research-based insights, followed by a Q&A. So please put your questions in the Q&A box, and Dan's happy to answer them both along the way and at the end. And we'll do our best to get to as many of those questions as possible. Dan, thanks for joining us this morning. I'm going to hand over to you.
Yeah, thanks so much, Nicola. It's great to be with you again, and really excited to share more about the framework. And obviously, especially right now, kind of given market conditions and a lot of economic turbulence, a lot of companies that have been in major trouble. I think that these concepts are more relevant than ever before. So very excited to dive into it. And I'll be talking a little bit about that CLV course that Nicola was just mentioning, kind of interspersed throughout the deck. So without further ado, I'm going to share my screen. So hopefully everyone can see it. And so really, it's just kind of equal parts. When we think about customer lifetime value and why it's valuable, it's kind of valuable for two reasons. Well, it's valuable for many reasons. But one of the reasons is it gives us a framework to understand how healthy a company is. So how good are you doing? But the second thing it can do is it can give us this diagnostic framework to think about what we might not be doing so well and how we can improve over time. And so that's kind of where we move from what I call measurement to management. And so we'll be talking about both. We'll be spending a little bit more time on the former, but we'll be moving into the latter as well. So as Nicola said, obviously the main kind of focal driving reason why I have experience in this area is through the academic work that I've done. And so I've written a number of academic papers on this topic, including this framework of customer-based corporate valuation, which Wharton marketing professor Pete Fader and I had popularized. The other, yes, as part of that, I've got this course that's now available through executive education for those who are interested in learning more about these topics and really diving a bit deeper into it. So if you're interested, definitely check it out. I think the link is in the chat box. I've also now put the QR code down in the bottom. So if you got your phone, you can kind of put it up there and always have it handy. So it'll be sitting there over the course of the rest of the presentation. The other reason why I have kind of some perspective on all these issues is I've actually co-founded not one, but two companies doing customer lifetime value. So the first company was called Zodiac. It was a predictive analytics software as a service firm. And we helped literally hundreds of companies make tactical customer acquisition retention decisions by programmatically ingesting all their transactional and CRM data, spitting out these well-validated predictions of what the customers will do, and then using that to help the marketers do marketing better. The company, we grew it. We had top-tier VC firms backing us, including First Round Capital and Felicis Ventures. We then sold the company to Nike in March of 2018. Really interesting story behind that. And then took some of the proceeds and also was able to work into our non-compete with Nike to be able to start a second company called Theta. And Theta has been doing very similar modeling, oftentimes for customer-based corporate valuation purposes. So yes, we've run these models. We've not only kind of done the academic work, but I've personally helped run the models on hundreds of companies to kind of see this stress tested, battle tested across a variety of different categories. Companies as large as in the Fortune 100, but also a lot of seed stage companies. So really it's kind of run the gamut. And so one of the things that we may want to know is, are you really creating value? Imagine that you're inside a firm, you're working really hard, but you want to know, is this actually contributing to value creation for the company? And if you're outside the firm, you want to know, is this a company that's actually creating shareholder value? It's just extremely important to know. Now, even if you knew that a company was creating value, there's kind of that next level question of, are you creating as much value as is possible to be created, given the options that are available to you? And there's kind of been two competing schools of thought as to how we measure value creation. On the one hand, there's kind of the Warren Buffett, I know a firm is creating value if the profit that the company generates exceeds the cost of capital of the firm, that I'm actually generating a return that's higher than what my investors are demanding of me. If you're doing that, then you are for sure creating value in the strictest sense. But the problem is most companies are not actually profitable today. And I contend that this was much more popular, say up to about a year ago, to just grow the business, grow this thing, and it's going to create, you're going to find you're going to find a path to profitability at some point in the future. Network effects, pushing on your supply chain. You're going to be able to sell ads at some point in the future. You'll figure it out, but just grow your revenue and you're going to be good. And the problem is there's so many examples of companies that have done a very good job of growing revenue, but have flamed out. They haven't done a good job of creating any profit. And now it's kind of accepted that they won't be likely to create profit in the future. So a few examples of this are Blue Apron, Casper, the direct-to-consumer mattress company, MoviePass. They've gone bankrupt one time, and now I think that they're kind of resurrecting it, but it's looking a little bit dicey. And Rent the Runway. There's now a whole slew of other companies, including instant delivery companies, that have been increasingly scrutinized. Is this a category that's going to ever create value? At least most of the companies, now we're really not so sure. And what I contend is that the truth is kind of somewhere in the middle between those extremes. If you're not profitable, what you need a path to profitability. You need to be able to communicate to your investors that even though I'm not profitable today, I will be profitable in the future. And to kind of move along that path to profitability, I think it necessitates a focus on kind of two things. The first thing is instead of thinking about profitability today, you need to think about marginal profitability. When I make an investment today, what is the incremental profitability of that investment in the future? And that's kind of the second piece of it as well, is we need to think about marginal profitability, but we also need to think about long-term profitability. That if I make an investment in, say, a customer, obviously that's what we're going to be focusing on, you will potentially get that initial purchase when that customer is acquired, but that customer may stay with you for a while. And so you may get future purchases from that customer. And we don't want to ignore all that future profitability when we're thinking about the investment that we make today. So marginal profitability, and we think about long-term profitability. And so the main things that we need are, we need to find what is the long-term incremental profitability of the investments that we can make. And we need to expand as much as we can the range of actions that we can take so that we have as many investment options as possible. And then finally, we need to manage our overhead judiciously. So you want your variable profitability to be high, but then you don't want to have a whole lot of overhead expense that kind of prevents you from translating that variable profitability into overall profitability at some point in the future. And the main thing I contend is, yes, you can think about this in general. In general, you want to make investments that have high incremental profitability. But what I think is a really undervalued way of kind of framing the problem is to think about that exercise in terms of the customer. So we make investments in customers or customer segments, and we want to see a return on that investment from the customer. And that's kind of the premise behind customer-based corporate valuation and customer lifetime value. So those of you who have heard customer lifetime value, that is really what kind of underpins all of this. So CBCV, you can think of it as taking customer lifetime value, but kind of financializing it. We kind of have, imagine we had two models. We had crystal balls that told us what future customer acquisitions are going to be, and then how long those customers are going to stay after they're acquired. That will get us the total size of the customer base in all future periods. If I then also knew how many purchases those customers are going to make and how much they're going to spend, that has to give us revenue. It's just kind of an accounting identity. And then from there, if I knew the variable profitability of the revenue, I knew how much we were going to spend to acquire the customers at the onset, which is what we call customer acquisition cost, or CAC, as well as the other overhead expenses, then that's what gets us to so-called free cash flows, which drive kind of most standard traditional corporate valuation models. So no matter how you kind of cut it, if you're doing corporate valuation off of some measure of cash flow, whether it's a multiple of revenue, a multiple of EBITDA, or going all the way to discounted cash flow valuation, this is a framework that can help you better predict what revenue and profit are going to be in those future periods. And so the main thing that we need to kind of bring this framework to life are models for customer adoption, when people come in for the first time, how long they're going to stay, how many purchases they're going to make, and then how much they're going to spend. So we just need models for those four things. And maybe I will, I'd love for questions to come in throughout. So maybe I'll kind of address this one, but please, everyone, to the extent that you have questions, other people probably have the same questions. So please don't hesitate to chime in through the chat box. So one question: how are you incorporating employee skills and learning and a growth mindset behavior as a part of the enterprise profitability model? Yeah, it's a good question. To the extent that you have been able to kind of improve, you have some sort of corporate learning for your employees over time. Presumably that's going to translate into more productive employees and also happier employees who stay longer. So the argument that I would make is that would manifest itself in terms of an improving contribution margin over time, to the extent that the direct labor that's required to generate the revenue has been going down over time. And also, to the extent that you're not having to turn over your labor force, presumably that means you're not having to rehire a lot of people, requiring all sorts of additional overhead expenses. So your overhead should be lower. So I think that's one of the beautiful things about customer-based corporate valuation, is that no expense is not accounted for in this model. And so the question becomes, how would something like what Steve is describing manifest itself in terms of the drivers of customer-based corporate valuation? I hope that answers your question, but yeah, if you had any follow-ups, please don't hesitate to chime in. Now, some may be wondering, okay, good framework, I get it. Is this just an ivory tower academic exercise? Now, I've kind of shared before that we've done this for hundreds of companies at this point, through my two companies, but it's also gotten a lot of media attention. So Nicola had mentioned Blue Apron. There was a lot of media attention that had been swirling around this analysis that I had done of them before their IPO. Another example of that was Wayfair. This was one of the two empirical examples of one of my other papers on customer-based corporate valuation, and it got Jim Cramer's attention. So hopefully this comes through.
Say the prolific left, he's really into this one, struck again when he tweeted his support of an academic paper published by professors at Emory in the University of Pennsylvania, calling it the smartest piece ever written on Wayfair. It did the job, causing Wayfair to plunge from 83 to 70 as of today. What was so devastating about a high-level academic paper? The professors tried to come up with a way to pin a value on Wayfair's current and future customers based on how much they make from these customers versus how much they spend to acquire them.
So there you go. And you think, doesn't that just kind of make sense that you have customers, they generate revenue, and so if we had some ability to predict what they're going to do, that can help us at the most basic level. That's the premise, and it's just not something that really has been done. So we're really trying to formalize that concept and put some rigor behind it, but it's able to actually move markets. It's also gotten a lot of kind of broad-based attention outside of the media. So there has been a lot of media mentions, but it's the only academic paper that's cited in the seminal McKinsey valuation textbook. That's the footnote right there. It's been in Harvard Business Review a couple of times. We've spoken with FASB about it, spoken with economists at the SEC, and then it's probably been in the media at least 150 times on various companies, including Wayfair, Slack, Farfetch, Revolve Clothing, Blue Apron, HelloFresh, and so on and so forth. So there's a lot more that I could say about that, but what I wanted to spend the rest of the time on is just a little bit of education about some of these key focal terms that really help kind of drive the framework. So obviously, customer lifetime value, that's the one that a lot of people have heard about. How do we get to customer lifetime value? To me, customer lifetime value is the overall net profitability of a customer, inclusive of how much you spent to acquire that customer. And so you can really kind of break it down into two pieces. The first is, how profitable is the customer after acquisition? So before I ding them for acquisition cost, how much am I getting after acquisition? And that I call post-acquisition value, or PAV. And PAV, it kind of determines the upper bound on CAC. If I know after acquisition, I'm going to get $100 in profit on a customer, I definitely don't want to spend more than 100. I probably don't want to spend more than about 33, depending on the type of business that we're looking at. Now, if I then subtract off customer acquisition cost, or CAC, that's what gets us to CLV. So there we go. Got 4 acronyms. We have PAV, CAC, CLV, and CVCV. I'll try to keep it to that. So here's a chart from a diligence that we had done a bit earlier. And the blue bars on the left, that represents the post-acquisition values of the average customer that was acquired in those different years. And the purple bars represent the customer acquisition costs. And so you can see is in 2018, the average PAV, the average value after acquisition that this company was bringing in was about $100. And they were spending about $42 to acquire them. And so the CLV in this case would be the 100 minus 42, so about $60. Pretty good rate of return. I would say this is they probably would not want to spend more than 42, just to be able to kind of bring in enough variable profit from each acquired customer to, at some point in the future, acquire enough that they can actually overcome all of the overhead expenses that the company needs to kind of keep the so-called customer acquisition engine going. So if you think about what a path to profitability means in terms of these terms, it's that you have good current economics, CLV to CAC is reasonably good. You're able to acquire enough customers in the future, and there's no kind of significant future degradation of your economics. So if you're able to acquire customers at 100, paying 42, and kind of pocketing that profit, mathematically, if you're able to acquire enough customers, you will become profitable. So yeah, that's kind of the fundamental contention. And what's really sad, and this is really, I think, what prompted me, I think it was like 4 years ago to start the CLV course, is that you have so many companies that are flying blind. It's just not something that's really being taught. And so it's as if there's this report card. And for a lot of companies, in addition to math, English, and science, they get unit economics, and they just don't even know what their score is. It's just blank. And so, you know, we need to know what those numbers are. And I'll also kind of analogize it to that of a doctor. It's like you want to know what your cholesterol level is. You want to know, you need to do your blood checkup to know what your numbers are. And it's as if the patient does not know what his or her cholesterol level is. You really need to know your cholesterol. So a big thing then is being able to actually get proper measurement of these quantities to know, is my cholesterol high? Is my cholesterol low? And so the three things that we need to actually get that measurement correct are, we need the right data. Most important thing is we need the transaction log. Who did what, when, and for how much? That's kind of the main thing that we need. Have that going back as far as we can. But what we also ideally want is we want a whole bunch of other stuff. Ideally, we want profitability data, ideally at the transaction level, but oftentimes that's tough to get. Fulfillment expense data. How much are we spending to ship our orders? You won't get that from a transaction log. Returns data. So which orders were returned, so we can be able to allocate that expense back to those transactions. How much are we spending on various forms of marketing? How many customers are we acquiring through that marketing? So that's all information that is very valuable, but won't necessarily come from the transaction log. So there's a lot of CDPs and other companies that are helping companies do a better job of kind of corralling all these different data sources together to be able to obtain this unified view of customer profitability. But it's not like you can just kind of snap your fingers and just get it. So obviously, perfect is the enemy of good enough. I think there's ways that you can be able to kind of do this without having all of this data at the start. So I'm very happy to kind of talk through that as well. The second thing that we need, in addition to the data, is we need the right definitions. A lot of people, they'll have great data, but they'll kind of define CLV in weird ways that omit certain expenses, or, they kind of define the lifetime in the wrong way. And when you do that, you may get directionally correct answers, but you won't actually know if your level is correct. Your CLV number will be wrong. So we need that. And then the third thing we need is we need the right predictive models. As we could kind of see from that earlier slide, we need a predictive model that tells us how long customers are going to live for. Because ultimately, if you acquired a customer 6 months ago, and it's a kind of a transactional business, you won't know how much more value they're going to create in the future, but you know that they might come back. And so you need very good models to be able to tell you, this customer is likely to make another 2 purchases. And so we want to account for that in our definition and credit the customer accordingly. So I could spend a whole lot of time on definitions. Maybe I'll just kind of take one. So post-acquisition value. This is the net present value of all the profit that you're going to get after acquisition from a customer. And so you need to know 3 things. You need to know the sequence of future orders that are going to be placed. You need to know how much revenue you're going to get from those orders. And then you need to know how much of that revenue we actually keep as profit. And so that's what I kind of mean by orders times order value times contribution margin. And now they all entail some sort of prediction, because you won't know these things for future purchases. But again, when we think about definitions, we want to make sure, for example, in the contribution margin, that we're actually accounting for all of the expenses that should be accounted for in that margin, and to not include other things. So what are the things that we want to include? We want to include everything that goes up as revenue goes up. So direct labor, materials, payment processing, shipping, fulfillment, returns, those are all things that happen every time you place an order. If you have to spend money on paid advertising like Facebook ads and TikTok ads to bring in orders from your existing customer base, you want to account for that as well. And then I would also include variable overhead expenses. These are expenses that may not go up with the very next order that's placed, but if your revenue was to go up by 20%, you know that those expenses are going to be going up. You will need more stores, that sort of thing. So you want to account for all of that. So I spent 2 full lectures on just this in my CLV course. So I got one class. It's gotten a lot of media attention, just kind of talking about the different variants of customer lifetime value, how people can get it right, how people can oftentimes get it wrong. So because you're in attendance, I'm going to just share the deck for this one. It's one that I've shared before once, but yeah, I thought that you might find it to be kind of interesting food for thought as you're thinking about the different ways that people actually misconstrue CLV.
Dan, before you move on, I've a question for you. Does this model work for B2B as well as B2C companies?
It does. Yeah. So it's you can think of it as that the framework stays the same. Like a B2B business brings in customers, they make purchases over time, and then the customers attrite, they leave. And so there's nothing different about that framework. Now, the models that you use might get a little bit different. And I'd say the behaviors that we see in B2B businesses are a little bit different. So for example, I mentioned on that media slide, I did an analysis of Slack and Slack technologies. A lot of you may have used them for, just kind of communications with people at your companies. They're a B2B business, and so they'll have their customers will be companies like McKinsey. And what we'll often see at a business like that is that revenue will kind of go up within cohort. So you have customers that are churning. In their case, it was they'll have a lot of startups that might join Slack, but then they don't get funded, they go out of business, and so they will have churn, but they get so much incremental revenue from the customers that stay that the whole cohort, the revenue from that whole cohort will tend to kind of expand very, very nicely over time. You really don't often see that in a B2C setting, at least not to that degree. So, so the framework is the same. The models that we use would be mostly the same, but you'll just want to make sure that you kind of account for some of those behaviors in the models.
Thanks, Dan. There's actually a related question here about, can the model, and I'm interpreting the question a little, can the model help you understand in a B2B business why customers eventually leave?
You could. Yeah, now oftentimes you may, so you can there's kind of the things that you can bake into the model and the things that you may want to do kind of ex post. So, we have models for customer churn. And to the extent that there is something that happens that's predictive of customer churn, you may want that in your model. And so as long as you then had a reasonably good, predictive model for how that thing drives churn, you can certainly put that sort of thing in the model. Now it's creating one additional source of uncertainty that you may not know whether or if that thing is going to happen to customers in the future. So there's kind of an Occam's razor for CLV where sometimes you may want to put those things in. It's easier if it is something like seasonality where there's no uncertainty as to when it's going to happen. But sometimes you may not want to put it directly into the CLV model. Now on the back end, you'd certainly want a second model that says, what are the kind of early indicators of churn? And or you may find that customers that have bad service experiences tend to have lower value, tend to churn more quickly. And that's something that we'll oftentimes do after we've run the CLV model. So we're now trying to kind of explain the shortness or the longevity of the customer relationships as a function of other data that we might have. And that's absolutely something we can do. We actually do that in the class, but oftentimes it's kind of more ex post as opposed to ex ante. The one other thing I would add about B2B is that B2B businesses tend to have fewer customers. And we don't need a whole lot of customers to be able to run these models and have them work very well. But if you have 50% of your revenue coming from one customer, which sometimes is the case at B2B businesses, especially a business that, you got one monster contract with Walmart and everyone else is just tiny. Well, then you really need to know what's going to happen with Walmart. And oftentimes the models that we would use they're just going to, it's not that they don't work, but they're going to be much more uncertain because you really need to nail it for that one customer. When a lot of the productivity, the accuracy of these models is kind of, when we kind of lump a whole bunch of people together, that the noise for any one individual customer kind of cancels out and you kind of see the baseline trend a bit more clearly. If you have so much revenue concentration, then that noise won't cancel out. So that's the one thing that you sometimes have with some B2B businesses that typically you don't even have to worry about with B2C, where you've got millions of customers. Yeah, keep those questions coming. So next question, got great definitions. Imagine we had great data. What do we do about the model? And there's kind of two distinctions that we'll often make when we think about what is the most appropriate model to specify given the data that we have. This actually goes a little bit to the B2B question. One of the distinctions is what is the business model of the firm? And now B2B versus B2C, yeah, that's important, but I'd say the most fundamental distinction is subscription or non-subscription. Now, a lot of B2B businesses are kind of fundamentally subscription businesses. You have seat-based pricing or something like that. But there's a lot of businesses of both types, and there's kind of a different model that we use for the one versus the other. And then the other is the richness of the data that we have. If we have richer data, we can specify a richer model. If we have dumber data, then we don't have the granularity, the richness of the data to be able to support the richness of that model. So I'm just going to talk through this a little bit. Subscription businesses is a much easier problem. Churn is observable. You know when customers churn. And so it's much more feasible to bring in some of the activities that we were just talking about a moment ago, these early indicators of churn, much more feasible to do that in a subscription setting. In fact, it may not even be possible in a non-subscription setting because, like, when did the customer churn? We wouldn't even have that data point. They just kind of stop buying. And that's kind of the really tricky thing about non-subscription relative to subscription is at a subscription business, we know when they've churned. Payments tend to be fairly steady while customers are alive. Just think you're a subscription to Netflix, you pay the same amount every month. And so all the uncertainty is really in terms of how long is that relationship going to last. Non-subscription, all bets are off. You've got the fact that you can't observe when customers churn, when customers are alive. Sometimes they're buying frequently, sometimes they're buying infrequently. You got a lot of variation across customers. When they spend, imagine at Amazon, if you just looked at my Amazon order history, one day you're buying a kid's book, the next day you're buying a $200, Theragun for physical therapy. So, the spend amounts are really variable. And so it's just, you can't use the subscription model. You need to have a different model. But the good thing is suitable models are out there. And in fact, that's one of the models that we learned in my class. So, I spend multiple lectures building out and specifying this model so you can actually go from transactional data to a fitted model that works really well for businesses like the ones that are being shown over here. So you go through the full estimation process. I got YouTube videos and all sorts of good stuff. So it's really powerful. I don't want to make it seem too hard. It's actually quite feasible to be able to do. So so the next distinction is about the data. Again, if you had internal data, if you were working for the company, you could actually directly observe the transaction logs. You had all that marketing data, you had the CRM data, you can really specify a very rich model. And that's actually the setting that we spent most of our time working in at Zodiac, that we could actually just ingest all of that data for the companies that we work with and then spit out these granular predictions for each and every customer. And then use that to come up with histograms like this one that shows the breakdown of CLV by customer across all the customers in the customer base. So again, also sign of the times that Nike, of all companies, was the one who bought Zodiac. This is a company that wouldn't have even given us a second look 20 years ago, 30 years ago, because they primarily sold through channel partners. They sold through Foot Locker. They weren't selling direct. So the visibility that they had into their customer behavior was quite limited, but it's gotten so much better since. I think it's a sign of the times that this way of looking at the world is very, very relevant, even for industries that traditionally it just hadn't been feasible to have the underlying transactional data for. Now at Theta, it's been interesting because we've probably gone 50-50. Sometimes we have the full transactional data. We've been actually surprised at how often we'll get it. But oftentimes, if you're in an investor setting, again, thinking back to that Blue Apron example that Nicola was mentioning, I just had the data from their pre-IPO prospectus. Same with Wayfair. We didn't speak with Wayfair. They didn't show us any of their data. We just kind of went into their SEC filings and pulled the data from that. And so this is going to be kind of the external data setting. You've got, quarterly customers acquired, the total number of active customers, et cetera, et cetera. And that's all we have to work with. And it's kind of like you're tying, a hand behind your back to be able to kind of do this modeling exercise. But what's surprising is you can actually do really well, even with relatively limited data. So that was actually my whole PhD dissertation thesis, was on this topic of extracting as much information as possible from aggregated data summaries like external data. The one other shout out I wanted to give was to Earnest Analytics. They're kind of an example of external data that can help enrich your analysis. They have a panel of about 2.2 million individuals that they can observe credit card statements for over multiple years for all, for something like 1,500 companies. So very good visibility. You can get very valuable competitive intelligence. You can also get market share sort of intelligence. There's a lot of other data sources kind of like them that you'll want to consider if you're kind of stuck in an external data setting, and even if you're not. So that's about measurement. So now you've got that cholesterol level. Your cholesterol is okay. Well, how do you bring your cholesterol down? That's kind of the next question that you might have. And that's where we kind of move from measurement to management. And so a lot of the second half of my class is just about management of value. So you got the A. How do you make it into an A+? And there's just all sorts of analyses that you can do that kind of come for free from this analysis. If you're just projecting revenue, you wouldn't have any of this. But the great thing about these models is you have individual level estimates of value, and you hopefully know where these customers were acquired through. You may know the first, the product category that they bought in. So you have all this stuff, and it allows you to say, well, it seems like my return on investment is higher here than here. So maybe I want to reallocate more of my budget towards my better performing customer segments, channels, acquisition channels, that sort of a thing. So this was an example of, again, PAV versus CAC, very similar to that chart I showed earlier on in this deck. But now it's PAV versus CAC by acquisition channel. And what we can see here is Facebook does not seem to be bringing in very valuable customers. The PAVs of those customers are about average. They're not bad, but the customer acquisition cost is significantly higher than these other channels. And you may say, well, you're not attributing enough credit to Facebook. Well, okay, but if you take two channels that are kind of at comparable stages of the purchase funnel, like Google's CAC is 76. And so oftentimes this sort of analysis can still be quite helpful, even if you want to think a little bit more about multi-touch attribution. And also, it seems pretty clear here, streaming is generating pretty good returns. So again, it's suggestive. This is typically at the stage where you'll then want to back this up with some sort of an experiment to be able to kind of prove out the return on investment, and then potentially allocate more budget from Facebook to streaming. Do the same thing for customers acquired in store versus online. So what we'll often see is customers acquired in stores are just more valuable customers. So again, this is post-acquisition value, but now we're looking at it across years for the in-store acquired customers versus the online customers. And just look at that blue line. It's just kind of rock solid flat. And we'll just very often see this, that maybe it's that they're close to the store, and so it's easier to come back more often. Those online customers, they have a lot of other alternatives they could consider more easily. And so it's just easier for competitors to poach your customers. And again, this is PAV. This is before we even take into account CAC. And oftentimes people will laud opening stores as being a way to reduce CAC. It's not even about the value of the customers after acquisition. Well, here we can kind of see, even before we account for CAC, the retail customers are more valuable. Account for CAC and they become even better. So in general, this would be suggestive of the merits of potentially opening stores selectively. A third one is you want to run experiments. So companies like Netflix and Stitch Fix have done a very good job of this. Experimentation allows you to prove out causal relationships. So you can say, I know that if I was to spend more on streaming, those customers will be more valuable. And that's something that you'll only truly know through an experiment. So it's not hard to do. There's now a growing number of companies that make it easier and easier to run experiments, even for relatively small companies. It's something to consider. Invest in a direct channel. So the great thing about going direct, and this is one of the things that Nike was able to exploit, is you're able to cut out the middlemen. You don't need to pay that margin to Foot Locker to generate that revenue. And because you can actually observe direct end customer behavior, you can see with much more granularity what your customers like. And so you know exactly what they're doing, you know who's returning what. Typically that just wouldn't even be feasible. So this is a whole new level of being able to kind of learn about the product, learn about what it is that is actually really driving value for your business. So yeah, I've got 2 lectures on strategies. You can think of it as like the CLB playbook, just different plays that you can consider as you're thinking about kind of bringing all this to life to kind of make your numbers better. And then we have a third thing on the customer centricity simulation, where you can kind of just experientially live customer centricity and invest in different channels and spend on data acquisition and see how customers in different customer segments retain. It's a lot of fun. We have a great time doing this every year. So key takeaways: 1, get your data house in order. You need the right data before you can do any of this. Again, if you were Nike 30 years ago, you might like customer lifetime value, but you just don't know what's going on because you don't have the data. Get the data. And that might require, so at the start, you might just have your transaction log and kind of aggregated filings. That's fine. And then over time, you may want to invest in the CDP and different ways to kind of bring those different data sources together. You want to cultivate sound measurement. Again, this is where my class comes in handy, because we'll talk through, these are the definitions and these are the models that you want to use to be able to kind of do those predictions. So that's what we spend most of the course on. Get that report card. You want to know what your grade is. So if you're flying blind, this will allow you to kind of know what your number is. You're going to want to invest in experimentation to prove out causal relationships between the actions that you take and the effects that they have. And then you're going to want to expand that range of motion that you can kind of take more actions. And so not all those actions are going to be good, but if you have the ability to send different emails to different people or target different promotions to different people, what a game changer. Instead of having to kind of send it out to everybody, which is what a lot of companies kind of have to do because they don't have the right instrumentation. So again, there's a lot of companies that do a good job of this. And then take action. So you look at those results for Facebook versus streaming, allocate the budget. If you've kind of really proven it out, start making changes on your website, your product development, based on the results. And then just kind of repeat all the steps. And so again, I mentioned before, perfect is the enemy of good enough. Just get started. You kind of start moving along this path, and incrementally over time, you start making better and better decisions. And it's kind of surprising, how good of a spot you can end up with by the time you get to the end. So again, I've got the link to the course. I know it's available in the chat. Please do connect with me. I'm talking about this sort of thing all the time on social media. And then I have a number of additional resources that I've shown over here as well for those who are kind of interested in diving a little bit deeper. And please email me if there's anything that you're kind of struggling with. Obviously, I'd love to take your questions during this webinar, but if you had anything else that you wanted to take offline, I'd be more than happy to answer those questions, over email as well. So that's all that I have. Thanks so much. And excited to spend the rest of the time that we have answering any additional questions that might still be on your mind.
So Dan, thanks so much for that. We do have some questions that have come up. Can the CAC data of your top competitors help with your predictions?
it can help with knowing what to do. So if you know that, like it wouldn't be, you'd feel a little uncomfortable if the CAC of your competitors was much lower than your CAC. Because it means that you kind of have to make more money after acquisition to just break even with them. They can be more aggressive on acquisition than you can. Now, the tricky part is how do you get that data? So they're not going to tell you. There's ways to use these third-party, competitive intelligence firms to get a cleaner read on what your competitors are doing. But typically, you can get a cleaner read on the purchase behavior. It's just so hard to get a clean read on the marketing spend data. That's just, and it really is the wild, wild west out there when it comes to competitive intel for marketing spend. So, so there are a few companies I've been kicking the tires with, but I'd say that's going to be the challenge.
Okay. Is it advisable to compare performance across your different B2B customers, even when they may vary by certain aspects? So I think they're asking about grouping customers into different sort of segments or different types.
Yeah. First, I'll say, Alex, I'm excited to have you in the class. I'd say that's the great thing about the CLV framework is you may have customers of all different sizes and shapes, but at the end of the day, return on investment, it's just, or net present value, those are just so fundamental quantities. If the NPV is strongly positive, that's a good thing. If it's not, that's a bad thing. So that really is kind of, when you talk about North Star metrics, it can serve much more as the North Star metric because of you really can't get any more fundamental than return on investment.
Okay. Jesse asks, is it bad to be using different CAC modes at the same time and spending with the goal of acquiring many B2B clients?
I don't know what a CAC mode would be, but I would say if you're spending on different channels at the same time, it can become a little bit trickier to attribute credit. Like, what was the marketing spend that brought in what customer? Now, the good thing with some of these channels like Facebook, Google, and TikTok is if you have that Facebook ad, someone clicks through and then buys, then you will know that customer was acquired through a Facebook ad. I think where things get a little bit tricky is sometimes they may see the Facebook ad, they may not buy, but it's planted the seed, and then 2 months later, they go to the website and they buy, and then that will not get attributed to Facebook. So that is certainly complicated when you have more channels, but this is kind of one of those cases where having perfect measurement versus kind of doing the right thing can potentially conflict. To only acquire customers through a single channel would probably not be wise, because you're going to have vastly different audiences that are kind of in the one area versus the other. And so by ignoring a whole channel, you potentially be ignoring all the people who don't, overlap with the customers in the channel that you are serving through.
Right. Another question, what are the mistakes that you've seen companies make either using or reporting on CLV and sort of related metrics?
A big one is sacred cows, that you just have these things that you've always done it that way, and so you want to keep doing it that way. And we've spoken even with relatively small companies that they just want to invest in Facebook, just as an example. And say, well, it doesn't seem like the returns are very good, but it's going to get better over time. And they just seem doggedly persistent. And it kind of speaks to culture. I think oftentimes, I don't know if it's a lack of education or something else, but if you don't have buy-in from the executive team that you need to focus on return on investment, that's kind of the way that you should be thinking about your allocation of your budget, then you may be able to compute CLVs and all the rest of it, but it won't get used, and that's just such a shame, because it's like the numbers are right there, what your cholesterol is, but you say, I'm still going to have that, that
annoyed ice cream and chocolate
cake. Yeah. It's just too good.
Another couple of questions have come in. How do the CAC models apply to a service-based business, which is both B2B and B2C?
Service businesses, in some sense, it's easier because the service component probably means that the trackability of the customer data is good.
Mm-hmm.
Yeah, you'll see who they are, so you won't have that issue of a purchase was made, but I don't know who it was from. Now, it does mean that you have different revenue streams, but one of the things that we strongly advocate is that you do not want to ignore some revenue streams to the extent that you can, because part of the idea is, and this is part of the value proposition for some of these businesses, you acquire them and they're doing one thing, but then you can potentially cross-sell them into other things.
Mm-hmm.
If you kind of ignore the cross-sell, yeah, that's kind of a bummer. So you may end up undervaluing your customers. And then, you know, to the extent that you're undervaluing customers, you may then end up being gun shy on your acquisition spend because you're saying, well, you know, my customers are not worth very much, so I don't want to spend very much.
Mm. Derek asks, is there anything unique that you need to be aware of when a product is purely digital? For example, a data service business or a subscription-based software, SaaS software platform compared to a physical product? Or is that all accounted for in the formulas for your cost of delivery and the contribution margin?
Yeah, that's kind of another one like B2B versus B2C. The framework stays the same, but the numbers will change. So, you know, if you're selling, if it's a product-based business, the physicality of that probably means that the firm won't be able to scale as quickly. Yeah, so there's just kind of issues associated with that. But, you know, at the end of the day, you know, there's kind of revenue that comes in, there's variable costs that are taken out. You know, the variable costs, if it's a purely digital business or a SaaS business, there will be fewer variable costs, which is part of the reason why those businesses can scale more quickly. But yeah, I think that the accounting framework will remain the same. Digital can be better, yeah, just because the more that's online, the more it's trackable.
Right.
That's the only other point I'd make.
So I think we've got time for one more question, and that is, given the sort of turbulence in the global economy, how does that play into the framework and how you use it over time? Because, you know, customers are feeling uncertain, they may not spend quite as much in the, you know, now or in the future. How do you account for that?
Yeah, that's a good question. There's kind of two ways that can manifest. One is in terms of customers being gun shy now. In the original customer-based corporate valuation paper I wrote, one of our examples was Dish Network. And we had this data set that ran through, including and past the Great Recession. And what you saw is, you know, there was this period of time where people churned more and they were less prone to being acquired. And then that kind of went away. So you certainly want to explicitly account for that, like macro fluctuation in your model by introducing some sort of covariate that, you know, demand right now might not be normal. And if you don't do that, then what's going to happen is you're going to kind of be pessimistic about demand because you're saying, yeah, this is just, people just don't want to buy as much now. So that's kind of on the customer side. You want to factor that explicitly into your model. The other side is on the investor side, and that's where it's a little trickier. You know, so yeah, I talk about path to profitability. One thing that we are seeing now is that some investors, they just aren't interested in like they're gun shy on investing. And that's actually creating a tricky time and potentially opportunities for these businesses that have great unit economics, but they're unprofitable now. They still may need to raise money, you know, and if they do, then they may still end up being in trouble. Right. So yeah, so I don't want to say that if you have a path to profitability, that means you will for sure get money. In times like this, you're going to want to you're going to want to be able to communicate that value. You know, it's even more important to be able to show that you have that path to profitability. But you know, that is kind of a factor that's just tough for money losing companies right now.
Right. Well, thank you, Dan. I'm going to hand over to Tammy.
Yes, thank you, Dan. Wow, such a lot of great information, a wealth of information, and we thank everyone for attending today. Want to make you aware of our future Business Over Breakfast that we have coming up. So June 15th, retention and engagement in a brave new post-COVID world. So we have two attorneys that are going to be joining us, Catherine McConnell and Blaze Knott. So we hope that you can join us for that session. And then starting in July the 6th, managing the dilemma, price and profit versus people and purpose. This is one of Dan's colleagues, Saloni Farasta Vestani is going to be presenting on that topic for us. And then our last session in July is measuring your inclusion maturity, bridging the gaps. And that's going to be another one of Dan's colleagues, Omar Rodriguez Fila. So we hope that we can see you on one, if not all of those sessions that are going to be coming up in the future. And I wouldn't be remiss if I didn't provide you with some more information on some of our short courses. As Nicola mentioned at the beginning of her opening, we do have our Goizueta Executive Women's Leadership Program. This is a hybrid offering. If you're really interested in really crafting your narrative and having a compelling narrative and increasing your leadership impact, this is a great program for you to join. It takes place between August the 15th and September the 21st. Applications are being accepted currently, and the deadline is July 28th. And our MBA level 4 credit courses, including Dan's customer lifetime valuation course, which you've heard a lot about today. If you were intrigued by the information that Dan shared today, and you have a lot more questions, but also want to get a lot more learning on how do you understand customer value and the framework for understanding how to derive it, we invite you to register for Dan's course. Applications are being accepted for that, as well as a few other finance and marketing MBA level courses. These take place between August the 23rd and December the 5th, which is our fall semester here at Goizueta. They're arranged in person, virtual, and hybrid. Dan's course is all fully online. It's held on Mondays between August the 28th and December the 4th. If you have questions on the Women's Leadership Program or Dan's course or any of our MBA for credit courses, please feel free to email us or reach directly out to me. I can answer those questions for you and provide you with the link for the applications. Again, thank you so much for attending today. Dan, thank you so much for all the great information that you shared and taking the time to answer the questions. We wish all of you a great summer, and we look forward to seeing you in our next Business Over Breakfast. Thank you. Bye-bye.